Okay, good afternoon. Thanks for coming. And I mean, we're here to discuss the economic, social, political, and market outlook for Latin America in 2022. So we plan to do this frequently, basically to update on the challenges and the evolution of social, political, and economic aspects in Latin America throughout the year. So I'm Alejandro Werner. I'm the director of Georgetown Americas Institute, and Muni Jensen will moderate the panel and will introduce all the participants. Again, thank you very much for being here.
Thank you, Alejandro, and welcome everyone to this panel. It is hosted by the Georgetown Americas Institute in conjunction with the Center for Latin American Studies, the Latin American Leadership Program, and the Center for Advancement of the Rule of Law. It's really great to be here in person. It happens less and less often, and hopefully will happen more often from now on. I am Muni Jensen, host of the Americas Table, and I'll be your moderator today. And we have a great roster, most of them in person and one on the screen. And we will try to, again, have an outlook of what is happening in the region as the world is starting to emerge from the very dark COVID years. And Latin America stands out as one of the most hard-hit regions in the world, not just by the amount of lives lost, but of the economic impact, the political fallout, and the breakdown of social structures. Inequality, unrest, poor economic performances are widespread, and we'll be discussing this today. And we'll also try to look ahead to assess some of the trends, risks, opportunities in Latin America, and the uncertain horizon. And to discuss the landscape and expectations, we will kick off with Alejandro Werner, the founding director of the Georgetown Americas Institute. For those of you who don't know him, he recently completed almost 9 years as director of the Western Hemisphere Department at the IMF. And prior to that, he rose to undersecretary in Mexico's finance ministry and taught at leading universities in the US. He earned his PhD in economics at MIT in 1994. Marcela Melendez, welcome. She will focus on the social impact of these economic conditions. Marcela is chief economist for Latin America and the Caribbean at the UN Development Program. She holds a PhD in economics from Yale and is an economist from Universidad de los Andes, a fellow Colombiana. And before joining UNDP in 2019, she spent 10 years as a partner and director of Econestudio, a Colombian consulting and economic research firm, where she was recognized for her contributions to the public policy debate. She also directed the mission of equity and social mobility, and that's some of the topics she will address today. And in 2017, appointed to an expert commission to carry out the expenditure and public investment review. Her research is focused on design and evaluation of public policies. Professor Chamis Hector. Chamis is an expert on populism, human rights, and press freedom. He will give us his view on the political trends coming in the next few years. Hector is an adjunct professor at Georgetown, also a weekly columnist for El País in Spain, and a frequent contributor to Clarín, Infobae, El Nacional, CNN, NTN 24, where we shared a lot of conversations, and other media organizations. He's the author of Reforming the States, The Politics of Privatization in Latin America and Europe, and a variety of journal articles and book chapters on authoritarianism, populism, democratization, human rights, and press freedom. He's a current advisor to the Secretary General of the OAS, a native of Argentina, received his PhD in political science from Columbia University. And meeting us virtually is Jose Luis Daza, who will wrap up the conversation with the impact of these three components on financial markets. Jose Luis, welcome. We're happy you could join us virtually. He's the founder and CIO of QFR Capital Management and a member of the Foreign Exchange Committee. Before founding QFR, he was managing director of Integrated Finance Limited, a financial advisory and asset management based in New York. He was a global head of emerging markets at Deutsche Bank, responsible for research in Asia, Europe, and Latin America, and a member of Deutsche's Emerging Markets Global Management Committee. He was also the managing director of emerging markets at JP Morgan. Daza studied for his PhD at Georgetown. He's a Hoya, where he received his master's and studied economics at la Universidad de Chile, receiving a bachelor's in economics from AU, also here in DC. So, as you know, you're in very good hands today for today's topic, and we will kick it off with Alejandro, setting the stage for us on growth in Latin America that has recently been downgraded for 2022 to a very dismal 2.4%, a number that's far too low to maintain a sustainable recovery. What do you think are some of the causes of the slowdown, and what is the outlook, more importantly, of the region for the next few years?
Thanks, Muni. And I have some slides to put this in context. Let's start with a view of how the world has evolved through the pandemic in terms of GDP growth. As you can see, I mean, every region in the world and every major economy except China went into a severe recession in 2020. And Latin America suffered the deepest economic contraction. You can see Latin America being the last region in this chart, and the blue columns showing you the contraction in economic activity during 2020. Then, on the back of important vaccination campaigns, on the back of economic activity adjusting to working through the pandemic, and also the response of economic activity to significant fiscal and monetary stimulus, I mean, the world economy recovered significantly in 2020. Almost every region in the world recovered at the same pace, between 4.5% and 5.5%, and Latin America in exhibiting a relatively similar behavior in terms of growth. However, given that it felt much more in 2020, the cumulative economic evolution was much worse. Latin America ended 2020 in a worse level vis-a-vis 2019 than the rest of the world due to the significant contraction in 2020. Now, I mean, let's talk just for a minute about the US, given its influence on global economic conditions, both from the point of view of trade, but also from the point of view of financial conditions. Everybody now is talking about inflation in the US. What would that imply for interest rates, for capital flows to Latin America, et cetera? So, I mean, what you see in this chart is the behavior of the labor market in the US. When the pandemic hit, we had a severe increase in the unemployment rate. Almost 25 million people became unemployed in 2020, and that's what you're seeing on the columns. I mean, the cumulative loss of jobs from the pandemic. But then immediately started in the second quarter, third quarter of 2020, you started seeing a significant improvement in the labor market. And the economy has recovered much faster than what everybody anticipated at the beginning of the pandemic. And by now, from those 25 million jobs that have been destroyed, almost we're left with only 3.5 million jobs lost due to the pandemic, and the unemployment rate is back to a range between 3.5% and 4%, very close to full employment. The difference between still 3.5 million people that have not recovered their jobs and an unemployment rate that is kind of similar to what we had before is what we call the participation rate, that basically not everybody that left the labor force is back either to work or to look for a job because of the uncertainty regarding if the pandemic will come back or not. Some people move cities and still are not thinking of coming back to the labor market. Some people receive significant financial support from the government, and they're using those savings to decide what they want to do next. And that's why, I mean, we're starting to see, because of many reasons, inflation pressures in the US, a significant increase in inflation last year that continues throughout this year, on the back of what has been called significant supply shortages. Basically, to restart global value change has been much more difficult than what people thought it would have been. Secondly, on the back of those significant monetary and fiscal stimulus, maybe aggregate demand was much larger than what the economy can accommodate on such a short notice. And also the labor market coming back to a relative tightness has given us the highest inflation rate in the US for almost 3 or 4 decades. And that chart, we're plotting average inflation, not end of year inflation. That's why the inflation rate for 2022 is larger than the inflation for 2021. But basically what people are expecting is high inflation in 2021, high inflation in 2022, and hopefully in 2023. Once the supply chains go back to almost normal, and basically the fiscal stimulus and the savings from those fiscal stimulus kind of, let's say, disappear fully in 2023, inflation pressures should go back to something much more moderate, especially if the Federal Reserve delivers on what people are expecting today, moving interest rates from 0 to something of around 2.5%, 2.75%, 3% in 2023. People are expecting 3 moves of a quarter of percentage point this year, another 3 moves maybe in 2023 to bring the interest rate in the US somewhere between 2.5% and 3% next year. And that has obviously affected long-term rates in the US, as you can see on the bars. I mean, the 10-year rate moving significantly to a range between 2 and 2.5% and expected to continue to increase throughout the year. Why is this important for Latin America? Because with 0 interest rates in the US, a lot of capital started looking for other investment opportunities that provided higher returns. And that obviously generated a move of capital towards emerging market, et cetera, and easier financing conditions for these countries. When this starts to reverse, then financial conditions for emerging markets and Latin America become tighter, and that obviously affects investment, affects the financing of the budget deficit, and therefore affects economic activity. I mean, maybe it's hard to read this chart. It's a summary of what the IMF is expecting in terms of economic activity. Still growth for the world, for the advanced economies, et cetera, above potential growth in 22 and maybe in 2023. Both the US and the Euro area expected to grow at around 4% this year. These numbers obviously are going to change on the back on developments in Eastern Europe and the conflict between Russia and Ukraine. People are thinking that maybe this will shape 1 percentage point of growth in the world, and obviously will generate another impact on inflation coming through commodity prices. People are analyzing the Russia-Ukraine conflict economic implications through the lens of a significant positive shocks to commodities prices, both energy and agricultural prices, and obviously significant uncertainty, most of that concentrated in Europe, but also affecting a little bit the US and other economies. I mean, the IMF kind of was expecting, after the significant increase in commodity prices in 2021, relative stability in commodity prices in 22 and 23. What you should think now is that there will be another step upwards, and maybe if the conflict gets resolved, some kind of normalization towards the original forecast, let's say, starting the second half of this year and going forward into 2023. Let's switch to Latin America. I mean, Latin America was a region that was hit the hardest because of COVID, both from the public health aspect and the economic aspects. On the public health, you can see on the chart on your left, excess mortality, basically mortality rates above the average mortality rates that these countries register, let's say from 2015 to 2019. So most of this is explained by COVID, and you have Peru and Mexico from the large economies being the economies with the largest mortality rate due to COVID, and many countries with larger mortality rates than what we have seen in the US and in other countries. And as I discussed before, economic activity being hit more severely in Latin America, that are the yellow columns, than in the rest of the world. However, what were the good news in 2021? I would say that the good news in 2021 is that Latin America did much better than what was expected at the beginning of the year. The orange part of that column, let's say, is the unexpected positive growth. The blue part was what analysts expected growth to be at the beginning of 2021, and the rest of the column is the observed growth in 2021. What lies behind the better than expected economic development last year? I would say first, I mean, a better economic activity throughout the world that also significantly impacted commodity prices, being Latin America a net commodity exporter that helped the region. Secondly, people were expecting that after important fiscal stimulus that were put in place to support the population in 2020, some of that was going to be withdrawn in 2021. Most of that expectation did not materialize. Fiscal policy continued to be relatively loose. Support programs continued to be in place throughout 2021, and that obviously supported economic activity as well, especially given that financial conditions in the world were relatively supported. And third, I would say vaccination campaigns in Latin America ended up being much better than what we all thought in the first 3 or 4 months of the year. So if you look at this chart, in the middle, you have a graph with percentage of the population that is fully vaccinated. Obviously, we have all heard of the cases of Chile, the cases of Uruguay, et cetera, in which vaccination campaigns were pretty good from the beginning of the period in which vaccines were available. But through times, countries like Mexico, Brazil, et cetera, ended up catching up, and they ended up with vaccination rates that were significantly larger or higher than what we thought at the beginning of the year. I think the IMF was thinking that vaccination rates were going to be around 40% by the end of the year. We ended up in a range between 55 and 80% throughout the region. The chart on your left shows the blue bars, what the primary deficit expected at the beginning of the year. The orange line is the observed public sector deficit that was much larger. And then you have a table with commodity prices that range between 50% and 20% better than expected prices for soybeans, oil, et cetera. The other surprise following what happened in the world, inflation in Latin America picked up significantly on the back of world inflation, on the back of commodity prices. But for some countries, let's say, for example, the case of Chile, that economic activity was much more dynamic than expected, and maybe the economy started operating already above potential. You have normal aggregate demand pressures also hitting inflation, and obviously monetary policy was significantly loose as central banks throughout the region lower interest rates to 0% in many countries to support the economy through the pandemic. So countries started to reverse those effects. Where are we going to end up, let's say, now that we're hopefully exiting the pandemic, in what many people have called another lost decade for Latin America? That's what the first chart on that slide shows, is GDP per capita in Latin America all the way towards 2025. And the numbers are the expected numbers that the IMF has put out. If you look at that chart, GDP per capita in 2025 is expected to be at the same level where it was in 2015. That's why people have called it another lost decade in Latin America, similar to the 1980s, where Latin America went through a debt crisis, and that also generated a flat GDP per capita. Obviously, that pushing significant social effects and generating important implications on the political aspects that this time around Hector will discuss. From the countries that are contributing to this dismal average for the region, I would highlight obviously Argentina, Brazil, and Mexico, and Peru, Colombia, and Chile are showing at least a positive trend in GDP growth throughout the decade, much less dynamic than before, but positive nonetheless. Poverty rates will stop declining as they were doing, let's say, from 2003 to 2018, and that will also generate important social effects that might have important implications throughout the region. Finally, I mean, approval of democracy, just an index, but to highlight the different aspects of social unrest that we have seen throughout the region, the political polarization that is taking over, and it's making for a complicated environment in which you have economic challenges, you have significant political challenges, and social challenges as well. So what would be the key issues? One is to try to reestablish a much more dynamic growth process, because, I mean, with these rates of growth, obviously the region cannot converge to developed country income per capita level. Latin America will have to deal with important fiscal sustainability issues and inflation control, and then a significant legitimacy problem of the socioeconomic system that has given way to the social unrest that we have seen in the last 5 or 10 years in Latin America. And obviously this will force society to try to reach consensus around building an inclusive growth model that significantly improves social services, but at the same time open up the economy to generate investment, job creation, et cetera. And this will pose, I would say, significant political challenges for the political class to try to build this consensus.
So this is a really good transition to Marcela. You've seen the numbers, the results are mixed. The rising inequality is a concern, the steep decline in employment, in health and education, and the social impact that this can create in the region that is so far ill-equipped for growth and upward mobility. So what are your views and your outlook about the potential recovery or not of the region?
Thank you, Mimi. I also have a presentation. It's a pleasure to be here, even if it's to talk about painful stuff. What I am going to argue is that Latin America was already in a very poor shape to face the pandemic, and that the outcomes, that the socioeconomic outcomes that we have seen are a result of pre-existing conditions. First thing that is particular about Latin America's labor markets is the large disproportionate share of workers who are self-employed or who work in tiny businesses of less than 4 or 5 employees. More than 60% of workers in Latin America were in this type of arrangement before the pandemic. Most of them in informal arrangements, meaning that they didn't have an affiliation to a contributory social insurance system. In the context of the pandemic, what informality meant was invisibility. When governments came out to respond and protect people who had lost their income from one day to the next, which is what happened to most of the self-employed, many of these people weren't in any administrative record from the government. So governments came out to respond with whatever they had in hand, which basically were their social registries with which they target transfers and policies for poverty reduction. So countries, they did great efforts, and some of them managed to somehow expand these registries, but they basically were able to reach the poorest among the workers who lost their jobs and income. We had a large share of the population who was not there, who was very close to falling into poverty, but not yet there, and who was invisible. So this is one of the things that limited government response. And the other, of course, was fiscal capacity, fiscal restrictions to actually come out with enough money to contain income loss. I have some evidence that I will show you in a minute to say that this response was not generous enough, and is not being generous enough to contain income loss and to contain the fall into poverty, and this is one of the challenges moving forward. The other existing precondition are the extreme inequality levels that we have allowed in our societies, that have probably their worst expression in terms of unequal access to quality education along the income distribution. What this meant is that students along the income distribution, even though it was like school closures were hard for everyone and probably represent a lagging learning for everyone, students along the income distribution face very different situations, with students from the households in the upper end of the income distribution being able to somehow continue their learning process in a somewhat like in a much better quality than students in the poorer families. And this is not only associated to different access to internet and to computer equipment and tablets, but also to a starting point in which education quality was very different along the income distribution to start with. So the capacity of schools and teachers to adapt to virtuality was different for the poorer students and for the richer students. Students in the lower end of the income distribution, many of them didn't even have a place in their homes, a desk where to sit and study. And then the role that parents had to undertake, becoming teachers to accompany the learning process of their children, is very different also because children in the lower end of the income distribution had, in many cases, parents who didn't complete anything beyond primary in terms of their own education. So this is probably one of the dimensions that will represent the most challenging gaps that increased during the pandemic and that we will have to face in what comes next. The lag in education and the split, like the larger gap, will means different capital accumulation over time. So it means different income over time, and it means more inequality. This is just a piece of evidence to say that I think speaks about the insufficiency of emergency transfers to contain income loss. We know that there were huge losses of employment for people who were employed before the pandemic, and we know, as Alejandro said, that we know that many of those people who lost their jobs have transited into inactivity. Among them, we have low-skilled workers and women without dependent children overrepresented among the new, among the new inactive. But what I think speaks to the insufficiency of government transfers is a finding that we have from household surveys done last year in alliance with the World Bank Poverty Group. We're finding that 38% of the previously inactive entered into activity. So we have movements in both directions. A lot of people who were out of the labor force, who didn't have a job and were not looking for a job, started looking for a job. Many of them found employments. Most of the new employments are informal. And among those who are moving, we have low-skilled workers, people between 18 and 25. So young people who probably left the education system to try to supplement income loss in their households, and women with dependent children among the new active workers. This sort of changed a little bit the story. This is just a representation of these flows that I think are part of the story that we need to be looking at when we talk about Latin America. And what I wanted to say is that in the beginning of the pandemic, we spoke a lot about a crisis of care and of women with children having to become inactive in order to go and take care of their children. What we're seeing by mid-2021 is a different story. I'd say it's a crisis of income loss, hunger, and poverty, because what we're seeing is actually mothers in large proportions coming into the workforce, many of them finding jobs, and look at the flows into informal employment. So all the new jobs created are mostly in the informal sector. Recovering to pre-existing conditions will not be good enough. And I think that's what we need to be thinking about. If we go back to the setup of where we were, we will not be able to, we will be just as unprotected in face of new shocks like the one we just faced. And this is just a little propaganda slide. The region was and remains in a high inequality, low growth trap. Last year we launched in June the UNDP Regional Human Development Report that looks into this trap carefully and argues that there are some factors that are making us both highly unequal and of poor growth. And these are factors that if we were able to address properly, could move the region in the correct direction on both fronts. This is the conversation that this report proposes is not unrelated to the conversation that we are having here today. There are some copies out there for people who are interested. The report is also online. Looking forward, the first thing that I want to argue is that we need to rethink our labor markets, including the way we regulate labor markets and our social insurance systems, because the regulatory framework, the way we have set up these markets, is part of the problem associated with the way in which employment is distributed across business sizes and counting self-employment. Here I have drawn the distribution of workers for Latin America and for the US, so that you can have, and across the income distribution. The Qs refer to quintiles, so Q1 is the poorest 20% of the income distribution, Q5 in each of the graphs is the richest 20%. And what we see is that in Latin America and the Caribbean, we have more than 60% of workers in these tiny businesses compared to the story in the US in the panel to the right. So it may be that we are at different stages of development and that this explains the way labor is distributed, but this is part of our fragility because this means that we have most of the people who are in self-employment and in tiny firms belonging to the poorer households. These are people who are making low incomes, who have little possibilities to improve their own productivity in daily training at work. So they have, this is a setup where their own welfare is hurt by the way the labor market works, but they are also hurting productivity and economic growth. And transfers alone will not end poverty. We need to continue providing them in the short run, and they are a tool to prevent falling to poverty, but they will not solve what we're observing. So this is one of the things that was there before the pandemic and will worsen because we saw how many people transited into informal jobs and they did transit out of the larger firms towards smaller firms and self-employment. Our report argues that the transit to universal social insurance system is possibly a point of entry into less distorted labor markets because we have set up regulations that somehow subsidize staying in informality or taxes belonging to contributory systems. So that's one point of entry that we should be looking about. Working labor markets, of course, require quality education systems, and perhaps this is the greatest challenge looking forward. It includes understanding how we can use digital technologies and the internet. We now know that part of the story is having students being able to use the tools of internet and to be connected, but it's not enough. We need to, I keep thinking that we need to be thinking about innovation in education and how we can really use the new technological tools in order to move forward and to somehow compensate what happened during the pandemic. And of course, having better equipped social protection systems and having better education systems requires fiscal capacity. So Latin America needs improved tax system, and this requires building consensus with the economic elites because in many of our countries, taxation is not only very little progressive in the sense of not like getting more tax income from the richer households, but it's also very low in terms of tax collection. So if we don't have enough money to pay for development, development will never happen. And just to close on a hopefully happier note, to say that not everything is bad. We did see giant leaps in internet connection and digital literacy during the pandemic. We saw jumps that we never thought would happen in such a quick time. So governments made great efforts, and this is something we are not like at 100% yet, and many of the households that are connected are complaining about poor quality access and even of energy cuts that has been a problem to be able to operate virtually, but we did see that we are capable of doing big leaps in short times. And also, I wanted to end with this. Yes, care, burden, and domestic work has been reported to have increased unequally more for women than for men. But there is something unprecedented. We have men reporting that they increased time spent in care of their children and in domestic work. The average for Latin America is 42% of men are reporting that they increase the time that they spend in their children's education, and 24%, a quarter of men in Latin America report that they increased domestic work. Why? Like, the reason this is unprecedented is because from what we know from household surveys, men spend exactly the same time per week in this type of chores, no matter if they are more educated, no matter if they're poorer or richer, no matter if they have like a lot of children or few children. So these signals to dynamics that changed within the households. probably associated to this very strange shock that had families isolated, and that probably led to renegotiations within households. Like but looking forward, we will see how the pendulum jumps back, or if it doesn't, in this and in increased female labor participation. That's what I have.
Well, hopefully it will be sustainable, because it's about time that that trend happens. So, Hector, you have the full picture, the economic picture, a very detailed social snapshot. We've seen already the results of these social and economic trends in the politics, in the rising populism, in the social unrest, in the retreat of democracy, and the increase of populism. We've had, in the middle of everything, a very busy electoral cycle. We had the elections in Ecuador, in Chile, upcoming, imminent in Colombia, and eventually in Brazil. What is your take on some of the main the expectations that you have for the politics in Latin America, and the outlook for the upcoming elections and the trends in the region?
Thank you. Thank you, Alejandro, for inviting me. Great to spend this time with you guys. Thank you, Muni. Always a pleasure. We haven't seen each other for about 2 years.
Yeah.
And it's about time. I'm glad to be here. I have a story to tell. I will address some of those concerns, Muni, but I want to tell my story, because as much as I try, I cannot steer away from the war in Ukraine, on Ukraine. And I also don't want to steer too much away, because I do think it has implications for Latin America in the future in so many ways. Let me tell a little bit of a story about how the Cold War ended. It ended with the Berlin Wall in '89, German unification, 1990, and the dissolution of the Soviet Union. The '90s expanded markets and widened democracy throughout Europe, and that in spite of the war and genocide in former Yugoslavia, something that is not remembered much about this, about today, because, well, this is not the first war in Europe since the Cold War. In fact, there wasn't any war in Europe during the Cold War, and that's why many realists keep missing the Cold War. Mearsheimer is very hot these days on the war, obviously. For those of us who studied international relations, we keep sort of opening our eyes big. The war in Yugoslavia, by the way, and it's pertinent for this crisis, ended in '99 with NATO intervention and the bombing of Belgrade and the capture of Milosevic. An intervention that was not made on the basis of Article 5 of NATO, because none of those countries to be was a member. Former Yugoslavia was not a member, but it was done on the grounds of humanitarian international law, the protection of human rights, and the prevention of genocide. And this is something that we need to talk a little bit more on that. Back to Latin America then, in that context of the '90s, well, we were all democracies, and we thought that Cuba was going to become a democracy as well. Cuba was going through a special period with the end of Soviet subsidies. It was beginning to open in sort of, market socialism a la Hungary, if you want. And it began to open, and we thought, well, democracy was around the corner. Think about this. In September 2001, all the countries in the Americas signed the Inter-American Democratic Charter, except one, that was Cuba. But Cuba will be coming along very soon. That's what we thought. But the Hungary metaphor is pertinent, because democracy was not in the minds of the nomenclatura elite in the island. The idea was to open the economy, introduce some market mechanisms to decompress the political system and recover room for maneuver. And that's exactly what the Cuban regime did, thanks to Petrocaribe and the close relationship with Hugo Chavez as of 2004, which made Cuba an oil exporting country. Think about it. It doesn't have any oil, but still today Cuba exports oil in international markets because it gets oil from Venezuela at subsidized prices, if prices that was a systemic change in our region. The projection of Venezuelan power under Chavez to the region with a very aggressive, very ambitious multilateral strategy, Petrocaribe, CELAC, ALBA, UNASUR, all had the print of Hugo Chavez and the Venezuelan regime. The economies of the region were growing. A political economy that ran on the commodity boom of the early 21st century with terms of trade unseen in the history of our region. Latin America in the first 10, 12 years of this century was more competitive than ever was. The bad news is that autocratic leaders began to take advantage of that because they had the resources of the boom to finance a couple of things that were sort of, new in the region, in the democratic history of the region. Number one, longer terms in office that stipulated upon arrival. Number two, new constitutions to seek indefinite re-elections. Three, a co-optation of the judiciary to the extent that in several countries of the region today, the judiciary is no more than an instrument of executive discretion. Four, curb civil rights and erode, if not completely dismantle, democratic institutions and ethos. Problem is that the boom began to turn by 2012, and that change of the cycle exposed our vulnerabilities and made us very fragile. International prices began to fall, and the cycle changed. There were four things that during the boom we could have done, and we didn't do, and that in some way speaks to you guys, economists. We didn't have enough fiscal savings during that largesse, essential for counter-cyclical economic policy, which we didn't have. We didn't acquire any capacity for counter-cyclical economic policy. Chile had it for a while thanks to the Copper Compensation Fund, which was an institution coming from the very end of the Pinochet regime and the beginning of the transition. We didn't invest enough in infrastructure. We didn't invest enough in human capital. The question of the educational drama that we see today is actually long-term. It comes from the past. And we didn't invest enough in public health, which is what we saw. It is true, I agree with Alejandro, the vaccination process went better than everybody expected, but at the beginning we have the brunt of the losses of the deaths and the brunt of the infections, right? I have some figures I want to share with you later. And worst of all, perhaps we had zero investment in institutions capable of administering economic cycles and negotiating its conflicts. We didn't invest in building stateness. We ignore the fact that growth is not sustainable purely on international prices, and you need institutions. You need centralized political authority with the capacity to specify and enforce property rights and all rights in general, collect revenue, and monopolize the means of force. And we lost that. Actually, I remember in 2014 there was a UNDP report about how paradoxical was that the economies were growing, employment was doing very well, and yet crime was growing together in the region. And it's paradoxical in one way, but it's, depending on the book you pick, it's paradoxical or not, right? Anyway, as a result, the 70 million new middle classes produced by the boom were exposed and became more vulnerable to the cycles of boom and bust. Latin America continues to grow through cycles of boom and bust, largely on international prices of the export products. And we keep dependent on, you guys go read about the political economy of the resource curves. We keep reproducing those cycles that make us dependent on resources, which is a curse. It's a curse because growth is very unstable. Growth is marked by sharp discontinuities, and is a good source for political conflicts and political violence. Democracy doesn't thrive in oil exporting or natural resource exporting economies. CEPAL at the beginning of, apropos the absence of a safety net, we didn't build a safety net for the change of cycle. CEPAL predicted at the halfway in the 2020, I don't know, we have to see because it is true that it wasn't, the fall was not as pronounced, but that the number of poor would increase by 45 million people. So more than half of those that enter the middle class would have returned to poverty, according to CEPAL-ICLA. If so, by 2020, 37% of the Latin American population was poor, a setback from the previous boom of the early 20th century. This context accentuated an inherent trait in the region. Marcela said something which is rampant crime and widespread insecurity. Look at this. Latin America represents 13% of the world population, but it amounts to 37% of violent crimes in the planet. The homicide rate is 17.2 victims per 100,000 inhabitants. Which is the highest of all regions in the world. 8 out of the 10 most violent cities in the world are in our continent. As of this, a new phenomenon entered our political life, which is the capture of the state, the capture of the political process by organized crime. In other words, the colonization of the state by, and its institutions by illicit activities. We have in both Spanish and English very important, very interesting words, narco-politics, narco-dictatorship, and so on. To the extent Muni mentioned corruption, I've written a little bit saying that, well, we should drop the term corruption because corruption doesn't quite capture this phenomenon by which politics, the state, is captured by criminal organizations. Corruption is a state official that keeps 10% of a contract for him or herself. All that has highlighted that money is a means for power today. It always was, but now it's dirty money. It's money laundered, money from drug dealing, and so on and so forth. And all this has become a model for export. We're slowly going in the direction of autocracy, de facto autocracy. Look at this. We're going in the direction of a single-party regime, which in Cuba is the jure. It's by constitution. Only one party has legal recognition. But we're going in the direction of de facto single-party regimes. They're not in the constitution, but that's how Venezuela operates. That's how Nicaragua has become. And Bolivia soon will go in that direction in many different ways. They call it the left, all right. Funny enough, I used to call myself a left-winger, and I don't know what I am anymore. Anyway, the picture is pessimistic, I would say, but we have more. Sorry for that, because we are at war. We are at war in Europe, nothing less. And a war in Europe suggests to be a systemic war. A war in Europe is always a systemic war. One that entails the breakdown of the international system as it existed and seeks to redefine and rebuild an international order. This has a problem, though, because that's what we've been trying to do since the collapse of the Berlin Wall. The world of the Cold War was predictable. There never was a shot was never heard inside Europe. There were peripheral wars, but never in Europe. So the Cold War was like a compass, was a good predictor. That's why realists miss it, and to some extent I do as well. Because this fluid and violent Europe again, you know, Europe is the most violent continent in history, by the way, is generating a number of uncertainties that worry me, of course, worry all of us, but also uncertainties that will entail dramatic questions and consequences for us in Latin America. Think about this. Kissinger's World Order, published in 2014, actually is about world disorder. It's not about world order. It's about the fact that the construction of that new world order post-Cold War was never accomplished. And yet we go now again into another reconstruction of world order, hopefully. How is the world going to emerge from that? That's the key question. How is the world going to look post-Ukraine war? Interesting. Un minuto. Good, I'm here. Europe doesn't seem to have any more space for neutrality. Look at Sweden, look at Finland, look at Switzerland. Expectations of staying neutral to not provoke the Soviets, the Russians, however you want to call them, doesn't seem to be the case anymore. Interestingly enough, by being non-member countries, Sweden and Finland have 6, 7, 8 cooperation agreements with NATO. I wonder why the West abandoned Ukraine back in the 90s. And not by making Ukraine a member of NATO necessarily, but by, as a non-NATO member, making agreements and cooperating with Ukraine, given that many people already knew the crucial role of Ukraine in the maintaining of stability in Europe. For us in Latin America, and I'm done, we have to do some serious soul searching. Where do we want to belong, essentially? Do we want to belong to the West, where people have voice, vote, and fundamental freedoms? Or we want to belong with the global powers that have been competing with the West in our region through proxy wars, that was your question, and with significant degrees of success. And those competing powers are China, Russia, Iran, and its outsourced operation Hezbollah, which are present in so many parts of Latin America. By the way, can't help it, today is the 30th anniversary of the bombing of the Israeli embassy downtown Buenos Aires, March 17. Well, we need to ask ourselves, who do we want to be? Because we don't seem to know very well these days. Thank you.
Thank you, Hector, for the context, and thank you, Jose Luis, for your patience. You have heard our speakers, and we are curious to know what the impact on global financial, of all the global financial and geopolitical situations that are happening, aside from everything that's happening in Latin America, how all this is shaping the behavior of central banks from the developed worlds, and what do you expect markets to behave in Latin America and in the rest of the world, while some of the main risks are so evident in the horizon?
Moni, thank you very much to everybody. I send my sincere apologies for not being there, but after being successful for 2 years in staying away from the virus, on Tuesday night, I started to get a headache and tested myself, and lo and behold, I have the COVID. So this is why I am not being present from you there. Can you hear me? Yeah. Before I continue, I just want to say something to the new Latin American Center in Georgetown, and I want to congratulate you for essentially for having been able to attract Alejandro Werner as the first leader of the institute. I have been lucky to work in multilateral organizations, in central bank of my country, in some of the largest research groups in Wall Street, JP Morgan, Deutsche, my own fund. And I can tell you that there are few individuals in our continent who are more respected in the world of macroeconomics, in the world of financial markets, and not only because Alejandro is someone who is in the frontiers of the theoretical understanding of macro modeling, but also because he has been in the practical implementation and in the interaction between financial markets and the real economy. I have been lucky to know him for so many years, and I can tell you, Georgetown could not have found a more distinguished, more respected, more intelligent, and more knowledgeable individual to lead this project. So congratulations. Having said that, let me separate my presentation in two areas. It's interesting because I'm usually one of the persons most negative about the long-term prospects of Latin America. I have thought for a long period of time, Latin America is a failed continent. Essentially, we have failed even in the most basic of the theories of growth, which is convergence, right? If you have countries that are very different in the stock of capital, stock of labor, capital labor ratios, some have, usually you would tend to converge. The poorest countries would grow faster than the other ones, etc. Latin America has failed over the last 100, 200, 400 years to converge to the United States. In the continent, there's only one country that for a period of time was able to converge, and that was Chile between 1985 and essentially 2015. Chile for a while grew at Asian rates. It managed to sustain them. It had investment ratios similar to the Asians. It was a country that, if you look, it's remarkable in the world. There are a few things in which Chile is number one in the world. We're not like Argentina, who was Messi, who was this, that, Nobel, but Chile managed to be the country between 85 and 2008 that reduced poverty the most in the world. So while Chile was able to generate high rates of economic growth, it was able to reduce poverty. And contrary to what the popular story is, when you actually look at the numbers, Chile dramatically reduced income inequality. But that part of the story is over. Chile is joining the narrative that exists in large parts of South America about society, how the economy works, etc., etc. Chile is fully launching itself into the Latin American narrative, changing. So the future for all of Latin America from the point of view of growth is not good. Is the same that it has been bad, or even in the past, or even worse. But let's move a little bit about the markets and the surprising shock, and the surprising shock that we're getting from the war, and which in general terms, I think, it is not bad for Latin America. As a matter of fact, for the countries that, especially those who export commodities, it is a positive in terms of trade, in terms of the impact. As it was said before, if you look at the cycles, political cycles, business cycles, economic cycles in Latin America, historically, they have all been following the terms of trade driven by commodity prices. So terms of trade went up, the countries did well. Terms of trade went down, etc., etc. And so that's the history of Latin America. This is a positive terms of trade shock, and it's good, especially for South America. Not so much the case of Mexico, that since NAFTA, essentially, it has changed the nature of the goods that it produces and exports. So let me go to please go to the next slide to start this slide. And why am I'm more positive? And sorry, what I have in this chart is the monetary policy rates of the countries that you see. So you have Brazil, Colombia, Chile, and the interesting part of this chart is not only the final part, but the part that starts in January of 2017, and especially the part that starts in January of 2020. This is what happened in 2020 is absolutely remarkable and extraordinary for this continent. For the first, the standard narrative in markets and in Latin America was that when there was a negative terms of trade shock, that is, commodity prices went down, etc., world economic activity went down, etc., the central banks of Latin America had to tighten monetary policy. That is the history. When bad things happened, we had to tighten monetary policy. We had to act in a pro-cyclical way. And what you saw during the pandemic, which was extraordinary from the point of view of policy, is that the majority of countries were able to dramatically lower interest rates. This is new. And the main reason why I think this is new is because there was an exceptional change in the form that countries indebted themselves. So in the previous crisis of Latin America, and not only Latin America, if you go to 1998, the Asian crisis, you would have seen that in 1998, essentially all of Asia had fixed exchange rates. So Thailand had fixed exchange rate, Indonesia, Philippines, Korea, etc. And that led them to borrow in dollars. All of them borrowed in dollars. So when the exchange rate blew up, their fiscal positions deteriorated dramatically. The countries in Asia learned the lesson: you don't borrow in foreign currency. That crisis that started in Asia, 97, 98, then moved on to Europe. So you see that in 1997, first Czech Republic, Poland, eventually Russia, of course, then Turkey, one by one had the same problems. The exchange rates blew up because they had a fixed exchange rate, they had dollar debts, and a crisis entailed. And those crises entail that the central banks had to tighten monetary policy to control inflation, to control this crisis from spiraling out. Then we moved to Latin America. Mexico was ahead of most countries and had floated the currency involuntarily in 1994. But then Chile, Brazil, one by one, the countries had to float. And of course, the biggest boom of all was Argentina in 2001 when convertibility blew up. Now, what is interesting here is that essentially, pretty much all the countries in the world learned the lesson. You have to borrow in your own currency. You have to have a match in your balance sheet. Your revenues are in your currency, have your debt in your currency. So what happened between then and now was that the countries issued debt in their own currency and they accumulated reserves. So when the devaluation came, because commodity prices were falling as a consequence of the recession implied that we expected coming from COVID, right? The exchange rate did their job. They all blew up, they all moved, they all adjusted significantly in some cases, but at the same time, the central banks were able to lower the interest rates. This is new, this is fantastic. This is a tool. And to a large extent, in a continent with very weak institutions, I can tell you, I travel everywhere. I just came back from, I think I may have got it there. I just came back from Egypt, but I travel in Asia, I travel in Europe, I travel everywhere. I can tell you, Latin America has outstanding central banks. They are institutions of excellence, surprisingly so. And they did a very good job being able to lower interest rates during the crisis. There's always one exception, and I have to tell you which is the exceptions. There's a Nobel Prize, Simon Kuznets, very, very important in growth theory, who essentially said there are 4 types of economies. You have developed countries, underdeveloped countries, Japan, and Argentina. Argentina is a case of its own on all dimensions. And of course, Argentina is the only country that did not learn the lesson. And when markets opened up, Macri, who when Macri was elected, I was very happy that we were going to have a potential change towards a competent, technocratic, modern country. I'll tell you, within a week of his joining government, we're extremely, extremely disappointed. Tell it to them, not to him, but to the people in government. I have a lot of, I was actually born in Buenos Aires. I have a lot of friends in Argentina. I have a lot of friends and Alejandro, you may want to, you may find this funny. When I joined JP Morgan, I was coming from the central bank. I didn't know anything about how banks worked, etc. So I asked JP Morgan, I said, can you put me in your training program for the juniors? I want to see everything they learn. And I was. And they assign you with one person. And the person who assigned, who became the best friends, etc., was Toto Caputo, who Alejandro knows well because he later became president of the central bank, had to negotiate with the IMF. But Argentina is, of course, the only country that didn't learn the lesson, and they indebted themselves massively. And when the currency blew up, the country essentially went into another crisis. But the rest of the continent did learn the lesson, and they lowered interest rates dramatically. And again, something interesting happened. They were very fast in raising interest rates. Usually, emerging markets, central banks, Latin American central banks followed the Fed. They would watch the Fed, what is the Fed doing? And sometimes, even in the case of Mexico, they used to have the meetings, the board meetings, in the day after the Federal Reserve, because they followed the Fed. If the Fed was raising rates, they had to raise rates. If the Fed was cutting, they had more room to pursue their own policies. But here, what is interesting is, look, the Fed is the bottom line there, and you can see that the Fed just yesterday, for the first time, raised rates. But look at this, at the central banks in Latin America. All of them moved fast. All of them moved quickly. And even though inflation rates are quite high, I think that they have done a very good job on the monetary policy front. And as I said, in a continent with weak institutions, they have outstanding central banks. Unfortunately, again, the country that stands out for not being as part of this common trend of of central banks that perform well is Argentina. Argentina is a different planet for these purposes. But please, let's go to the next slide. So here's interesting. Do you remember, this is all new. This is all relatively new. Look at this chart. So what you see in this chart, I just selected a few. I selected the real, which is real, the Mexican peso, Chilean peso, and Colombian peso, just to show you some of the things. And look what is interesting. The currencies, all of them adjusted. This is the price of this is exchange rate in dollars. So a move up means that the dollar is strengthening and that the currencies are weakening. So what you can see is that in 2020, when the pandemic comes, all of the currencies explode upwards. All of the currencies weaken. And what is interesting of this is that the currencies were doing exactly what you want them to do, the shock absorber, right? You want them to absorb the shock. And what was interesting is that the countries could do it. Why? Because they have very little debt denominated in dollars. And on the other hand, they had a large amount of dollars in their central bank reserves. So actually, when the currencies depreciated, their fiscal position, the balance sheet of the state was strengthening. So the risk premium embedded in interest rates actually came down, which is a first. So not all is bad. The central banks learned their lessons. They allowed the exchange rates to work the way they should. And they, as bad as the crisis was, this is a very, very nice, relatively efficient adjustments of the different economic variables to what was a very negative shock. And what is most interesting is as you can see, the currencies have remained in a range. You can see there, they have a first jump, and with the exception of Mexico, that has been steadily appreciating for a while and their state. But this is the currencies in Latin America jumped and have stayed there. Now, what is the most interesting thing since then, since this jump? And it is this year that while the euro is appreciating, currencies around depreciating against the dollar, when the other currencies in Asia are depreciating, the Latin American currencies, it's too Chuck, are appreciating this year. So we have currencies that are appreciating in a world where you have the Fed, the feared Fed. We always panic. The Fed is going to raise rates, what? And the currencies appreciate. It was in the prices. Now, I must say too that there are two forces affecting the currencies. On the one hand, you can say that the commodity price shock is positive for most of them. Not for all of them, for most of them, especially South America. And that helps you. But clearly the Fed raising rates should be negative, and the currencies have been appreciating. I think that this is to a large extent what the markets anticipate events, and to the positive job that the central bank. So the currencies have depreciated in 2020. They're very weak by valuations, by historical valuations. The currencies across Latin America are probably at the weakest levels that they have been in decades, especially when you adjust it for the commodity prices. I must say again, Mexico is a different story. The productive structure of Mexico has changed dramatically. So at the margin, this shock in terms of trade is negative for Mexico. So please, let's go to the next one. Now, one back. Now, here is the other element of it. So what is one different, what the central banks did? It's very interesting because you have all heard of the quantitative easing in the United States, in Europe, and in Japan. What is quantitative easing? It's a fancy name for the central bank lending money, or the central bank giving money to banks, right? How does it give money to banks? It buys the US treasuries that these banks have, and it buys mortgages. They're intermediaries, right? So the central bank has been buying and buying and buying treasuries and mortgages. Countries in Latin America didn't expand their balance sheet. They did not go to buy. The only exception was Chile. Chile did not do it in the form of treasuries, did not buy treasuries, but Chile did give loans to banks, and the banks in turn around and lend money to companies. So it is really interesting that the central banks in this episode performed a role totally different with history. So let me go. Now, what do we expect going forward? Well, as inflation has gone up, you saw the central banks acting very, very quickly. They're very committed to fight inflation, and they're crucially, for the first time in history, I would argue that they are in a better place than the Fed. The Fed looks really behind the curve in this matter. Let me go to the next quickly. I don't want to take too much time. I have to talk about markets, right? That's what I was asked to talk. And let me tell you a little bit. So I am in the near term, and I'm not talking about the long term, because as long as we don't generate the growth conditions that can lead to convergence with the developed world, we're going to run into problems of solvency, of debt. We're going to be running into problems, as Alejandro said, of legitimacy. We're going to have problems of violence. When we don't produce more resources, the only way I can have more resources is taking it from you. It becomes a competition from where I take. If we want more hospital beds, more schools, we have to invest, we have to produce them. That is economic growth. Without economic growth, Latin America is condemned to the mediocrity it has been and to the very violent continent it is. Now, what do I show here? So if you had invested 10 years ago, the chart is more dramatic if you go 20 years. So if you invested 10 years ago, you invested $100 in the S&P, today you would have roughly $250. If you invested $100 in the Chilean stock market, you today have 50. In Brazil, you have about 60, and Mexico did a little bit better. But in all of the markets in Latin America, you lost money. And what this reflects is a combination of two, because these are valuations expressed in dollars. And what this reflects is that the companies have done very poorly, and number two, that the currency is weakened over time. So I have a metric of valuation that we use in markets to see what are the companies pricing in terms of growth. So what you see here is the price earnings ratio. That the price earnings ratio, it essentially tells you how many years of earnings you need to recover your money, right? In Latin America, this is what it's called the CAPE. It's a cyclically adjusted. This is a measure that was generated by Robert Shiller, Nobel Prize in economics, for his work on finance. And what you see is that the cyclically adjusted CAPE in Latin America is 10. In the United States is almost 30. Assets in Latin America are cheap, probably rightfully so, but we don't need a dramatic correction. I actually think that for the next year or two, the outlook is not bad for Latin America. We have avoided the crisis of the past. The central banks are acting prudently. The commodity prices is for many of them a plus. And geopolitically, I think that as as Europe in particular, whatever the resolution is, and here I'm going to play amateur geopolitical analyst, whatever the resolution of the conflict in Ukraine and in Russia is, I think that you will see that Europe and some countries like Egypt will definitely want to diversify their source of essentials for the life of the population. So they're going to look for alternative sources of food, agricultural goods. They're going to look for alternative sources of energy. And I think that even this translates into the politics. You already saw the Biden administration making signals to the Chavistas, et cetera, So at the margin, at the very margin, I think that this shock, unfortunately, horrendous shock, is not bad for Latin America. Let me tell you just one more things about the shock and the tragedy that's going on. I was very, very involved in Russia in the post collapse of the Soviet Union, and in Ukraine too, and visited, had to do work with them a lot. And it's a tragedy. It's a tragedy of missed opportunities by the West, of the brutal. I was there for Alejandro. I thought that the IMF program they imposed on them at that time was brutal, was total lack of wisdom. I participated because I was at JP Morgan, we were trying to help, etc. And the lack of vision was exceptional. And unfortunately, it has degenerated into this situation now with whom apparently seems to be a madman. So let me leave it there for now. I'm giving you a little bit of a sense. I have not talked about the other markets, the market for interest rates, the market for bonds, for the markets. But in the near term, in general relative terms, Latin America is looking not bad for 1 to 2 years. Asia is suffering from what's going on in China, which is not good. From a variety of sources, is not good. Europe has the problems it has, and in relative terms, Latin America is. And I was looking. JP Morgan conducts a survey of money allocation, investors. They have several conferences, more than 1,000 investors, and they're saying, where are you more underweighted? And the conclusion was Latin America. And the marginal dollar that you're going to get, where do you think you're going to put it? And it was Latin America over Europe, Asia, and the other place. So in a continent that has the same underlying fundamental intrinsic problems that have caused the situation which we have now, at least cyclically from the point of view of the markets, there's an improvement versus previous crisis, and the near term does not look that bad.
Thank you, Jose Luis, and you seem to have a lot of energy for somebody with COVID, so I really hope you recover quickly.
Thank you.
It was very...
I was very nervous. I'm always very nervous when I'm talking to students there, but I'm very nervous also because my son Daniel is sitting with you guys there. He's also a Hoya.
Raise your hand. Well, he did great, so...
He's getting a good grade.
Yeah, well, thank you very much. And I think we have time for only a couple of questions. We're going to completely miss the second round because there was some overperformance of our speakers, but we're happy to take your questions. Please let us know your name and who you're asking the question to. So, go ahead. Yes, for the question.
Thank you for the presentation. My name is Margaret. I'm from Peru. And I want to do this question to Marcela because you talk about social protection and social insurance. And as you know, Peru is one of the countries that have the highest rates of labor informality. So I wanted to ask, what should be the first steps to build shock-responsive social protection system? Because I think that it's not just to talk about, social security or social insurance like separate, because I think it's necessary to talk about a system of social protection, but not just social protection, but also shock responses because of the emergencies that we are facing now.
Yes.
Thank you. You're right. I think we should think social protection systems as a combination of two different pillars. Social assistance, which is what we do through transfers and policies to protect or to eradicate poverty, and social insurance systems, which are these systems that should work to protect us from risks that all of us face: longevity, health risks, unemployment, discapacity. What we have set up better in our countries, including Peru, is the social assistance pillar. So this was all we had to respond. And it was insufficient because we didn't have the other pillar. And as I said, part of the problem was that we have had a lot of people out of our range of visibility. Governments didn't know where to look for these people. Brazil was able to overdo its response, and it's one of the countries that ended up diminishing its poverty rate during the pandemic through transfers, because they sort of did an open call and allowed people to self-select if they needed help. All of the rest of our countries tried to do whatever they could based on social registries. So I believe that for shock response, we should rely on transfer systems and emergency transfers, but this will only work if we also have the other pillar working, which is what failed like horribly during the pandemic. This is the case of Peru and of the rest. So the big challenge looking forward is how we revise these social protection systems, social insurance systems that didn't work.
Any other questions?
Hi, I'm Gerardo Penchina Cárdenas. I'm a first-year Master's of Latin American Studies. The question is pretty much for all of you guys. DASA talked about the possibility for Egypt to sustain diversification of the economy now due to the wheat and corn prices that have inflated due to the war in Ukraine and Russia. And my question is for Latin America. Is there a possibility for us to surpass this Dutch disease, this resource course, and really like moving forward and like diversifying our markets, like the way that Pinochet did it, perhaps autocratically, or Mexico with the manufacturing sector? And that being said, like, do we need democracy in order to diversify? Have we been able? Because like we see authoritarian turns, I think we're going to see a pretty strong one. So in that sense, yeah, is democracy tied to economic growth?
I'm going to kick this off to Alejandro. Thank you. You're welcome.
No, but let me use the question as an excuse, maybe to bring two or three things that were discussed in the panel together. I think one is what Hector said, that, I mean, we're seeing a tendency towards autocracy, towards modifying the constitutional and legal frameworks that we have, maybe to move away from democracy. And maybe in Hector's, and like in everybody's comments, given that we only had 10 minutes, we bunched many things together. I think the problem runs a little bit deeper, because it's not that all the countries kind of move away from a sensible economic policy framework. We've seen, I mean, a group of countries trying to do the right things with the political constraints and the social constraints that you face in countries that have elections every 4 or 6 years, and they have political pressures, and you have a parliament, and you have governors, and you have the private sector lobbying, etc. And in that sense, you have Chile, you have Colombia, you have Peru, you have Mexico, Uruguay, trying to do these things. And then on the other side, you have the Venezuelas, you have the Argentinas, and you have the Ecuadors, etc. And in that sense, I think the deeper and even more troublesome question is that even those countries that tried, the speed at which the effects that your reform eventually translates into economic well-being in a very complex system where the economics, the politics, and the social get together, maybe it's not the one in which the median voter has to elect every 6 years a new government. And in that sense, everybody's drifting towards this kind of less democratic systems, and that at the end of the day also end up proposing kind of quick fixes that do not pan out exposed. I mean, you had many countries that wanted to do some savings, that used those savings to do counter-cyclical policies, that build institutions, at least on the economic side, as Jose Luis was saying, on the central bank, etc. And at least at the voting booth, that is not being reflected by the voter. And I think the problem runs, obviously the economics have not fully delivered on what all of us expected, but also socially there are much deeper currents in terms of legitimacy, in terms of discrimination, in terms of equal access to justice, etc., that are undermining a move towards democracy, etc., because we're not fixing also those issues. And let me just finalize, maybe, I mean, Marcela, myself, etc., focus a lot on social protection, on a more powerful state to deliver on these public goods, but also you need growth. And growth, I think from what we've seen throughout the world, traditionally is much more likely to come from a vibrant private sector, from opening up the economy and actually doing this division in which the state focuses on social protection, on some redistribution, on public goods, but it opens up spaces for the private sector to deliver a much more vibrant employment creation, and blah, blah, blah. And that part also, I think, is under threat in Latin America today in providing this space for the private sector to really generate a much more vibrant economy.
Thank you, Alejandro. And it is 6 sharp, so I'm very sorry for those of you who had questions. I wanted to share something. The Georgetown Americas Institute has a very busy life on social media. So please connect with us through Instagram. There's a LinkedIn, there's a Twitter, and continue the conversation on social media, which everybody loves. And also maybe suggestions for future events. So thank you all for coming. Thank you for our panelists, and have a great afternoon.